Welcome back, everyone, to our Tuesday morning macro outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And a week later from last week, we largely find ourselves in the same place with regards to equity markets, just shy of major resistance levels on the cusp of potentially breaking out here. And the question for a lot of investors becomes, do we break out to new all-time highs and continue the bullish trend that we've seen over the past 3 weeks? Or do we start to see some weakness as we approach these all-time high levels? So let's take a look at the chart and try to answer those questions. So on the S&P 500, we basically got ourselves back up towards that all-time high level. We did not manage to break out above that level. Friday's close was, the closest close to that all-time high since making that back in mid-June. But overall, we have not managed to break out higher from here. Momentum has slowed down quite a bit here over the past week. And we obviously are about to open slightly in the negative here for pre-market. Now, generally speaking, bounces like this don't just simply take a single bounce and just continue moving higher. Historically speaking, when you have these kind of violent sell-offs and get a subsequent bounce, it tends to be a subsequent retest of the previous lows, which happens to be around 5,100 here to the downside. We have labor market data coming out later this week. We know that the volatility 3 weeks ago were driven off of weakness in the labor market numbers. We get that, we get different labor readings Wednesday, Thursday, and the big one is Friday for non-farm payroll and unemployment rate. So that is, in my opinion, the biggest risk that I see to equities is those labor numbers, and any potential softening of the labor market is what spooked the markets last time. Brought up the concerns around recession and brought up the significant sell-off we saw in the S&P 500. So you look at the Qs, what you see here is that on the Qs, we didn't get ourselves back to all-time highs. We did manage to get above the 50-day moving average, just barely holding on to that 50-day moving average. And the concern here is that we start to see a little bit of downside on the NASDAQ 100 as well, which if you look at pre-market right now, you have stocks like NVIDIA down, 2%. Those are the stocks going to drag the NASDAQ 100 lower here versus the S&P 500 today. Looking at small caps, we also have the same chart as the NASDAQ 100, where basically the subsequent rally has not gotten ourselves back to the 2-week high, and risks some downside, especially if we see some softness here in the job numbers this week. You do have the equal weight S&P 500 breaking out to new all-time highs and actually continuing to move higher. And that is actually the one thing about equities that continues to improve, is that market breadth has continued to improve. You have the rest of the market that has been lagging behind, playing a bit of catch up here on the rally over the last 3 weeks. That has continued. And that is really kind of the one thing that's balancing some of the negative factors that we're seeing right now up here for equities at the moment, is the fact that kind of the rally here is broadening out. You have growth outperforming value for the better part of this year. But over the past couple of months, we have started to see value outperform growth. That's the catch-up, if you will, of the rest of the market that's being played out at the moment, where the stocks in the Russell 2000 are outperforming stocks in, let's say, the NASDAQ 100. Playing that catch-up is overall healthy for the markets in the long run, because markets can't just run in excess. Small parts of the market can't contribute to the very large performance of the indices if the rest of the participants don't follow suit. And we've been warning about those risks for what feels like quite a few months now. And the volatility we saw 3 weeks ago was sort of a direct result of that fairly narrow market where everyone's heading for the exits, at the same time. is when we get those very violent sell-offs. Um, so, that's kind of how we're viewing the overall markets here right now. If you look at commodities, we kind of continue to moderate around this 21 level here on GSG. The commodity ETF, which really kind of shows you that commodities at this point doesn't particularly have a strong direction one way or another. You have gold near all-time highs, you have oil near 52-week lows, kind of opposing forces here right now, and both kind of dragging commodities into much more of a neutral state than bullish or bearish. You have high yield corporate bonds that continue to move higher and grind higher here. That continues to signal a risk on environment. However, I will say that the momentum of these continuation higher on bonds has waned significantly. We've obviously seen some weakness from treasuries here over the past couple of trading sessions that have, led the 10-year yields to rise back closer to 4%, reflecting kind of the market's continued angst with kind of how performance is going, with how just how the lack of progress that equities is making here right now. But high yield corporate bonds still eking out a bit of a positive signal here right now, but just positive by a little bit, and could potentially start turning negative here over the next couple of trading sessions. So be kind of on the lookout for that. We have the VIX settling in around 15% here over the past couple of weeks. We've made some pretty significant round trip in terms of volatility expectations, but we certainly have normalized here around that 15% mark over the past week or so, suggesting that the majority of the fear has receded from the equity markets. But like I said, the one thing that could potentially bring volatility back is really kind of job numbers that's being reported later this week. You have the 10-year treasury yield, like I said, hovering around 3.9% here right now. On the back of some weakness here we've seen in treasuries over the last couple of trading sessions. TLT, we've had that breakout above 94, but subsequent the retest of 94 as a resistance as a support level so far did hold. But it looks like we're kind of coming back towards that 94 and that 50-day moving average to the downside on some weakness here in the treasury markets at the moment. The US dollar has bounced off this $100 level here. We've seen a little bit of strength here. I think you could see a little bit more strength here from the US dollar before we might potentially turn bearish here again on the US dollar. And then if you look at this, and then if you look at gold, this is what I was referring to. Gold continues to hover right around that 25.50 all-time highs, while oil, hides out around 73, 74, near 52-week lows. So very different dynamic between oil versus gold. Gold kind of acting as a safe haven and continues to act as a safe haven in this current market environment. Demand for gold has remained incredibly robust. At the same time, if you look at oil prices, really reflecting kind of both a picture of supply that is oversupplied and demand that just isn't there, which is why we have oil trading near 52-week lows despite the tensions that we currently have in the Middle East. So despite all of that, oil is still trading around 73 or so, 73, 73 and a half, which overall in the long run provides more of a buying opportunity as it trades near these 52-week lows on oil. So looking at the individual sectors, what's interesting is that majority of the sectors play a minor amount of catch-up, but there is catch-up nonetheless. And what we have seen are sectors like technology lose that ground relative to those other sectors. So technology, which has largely driven this rally from the last few years, have kind of lost its spot at the driver's seat with regards to the overall U.S. equity markets. So the U.S. Technology, as you can see, trading back below the 50-day moving average, something that we haven't seen across most sectors. And you can see the relative performance of the S&P 500 is poor over the past week or so. So technology certainly looking heavy and looking at risk of potentially rolling over a little bit further here. You have consumer discretionary that is largely flat here, holding that 50-day moving average, potentially looking for a continuation higher here towards that 195 all-time highs on XLY. You have communications that has started to lose ground here a little bit. You have this double top at 88, or call it a triple top at 88 so far. That's been respected, with a little bit of underperformance here relative to the S&P 500 as it retests that $88 triple top level here. You have financials that have broken out here above that $44 level. You broke out and continue to move higher here. So this is one of the sectors where we've seen quite a bit of rotation into. I would say out of all the sectors, financials have seen the strongest amount of rotation into XLF. So if you look at the major banks, JP Morgan, Citigroup, all of these names, are potential candidates for a continuation higher here within XLF as a sector. You have consumer staples that broke out above 78 and actually continue to move higher here. But note that the breakout higher here isn't really confirmed with much outperformance. So from my perspective, less likely to see XLP continue this momentum much longer here, that you're going to start seeing a little bit of a stalling out in terms of momentum and a potential reversal here over the next week or so, especially like I said, with job numbers coming out later in the week. You have healthcare that broke out above 152 and continue to march higher here on a slight amount of outperformance here. Nothing quite to write home about. You do have materials breaking out to new all-time highs, which is interesting as it sort of outperforms the S&P 500 during that period of time. And then you have industrials that also broke out above 128, the all-time highs, with a little bit of outperformance here as well. And then looking at real estate here, we did break out to new relative highs and continue to move higher here. Slight outperformance or so, and then energy really moving sideways during this time, and not outperforming or underperforming by much, or certainly not meaningful enough to mention that. And utilities continues to grind its way higher here as it kind of slightly outperforms the S&P 500. Home builders is one industry that kind of has managed to get itself back up towards those recent all-time highs, forming that double top. It has outperformed the S&P 500 during that time. We'll see if that can continue. This is certainly one of the sectors that have seen some strength here over the past week or so. And then lastly, semis. This is really where we continue to see some weakness here. This is what likely will continue to drive some weakness here in the equity markets, as you can see, the 50-day moving average is sloping lower here for semis, and you have a market that continues to trade below the 50-day moving averages that slopes lower, so kind of continuing to suggest potentially some further downside from semis. So one area of the market that has driven equities higher continue to show some weakness here at the moment for equities. So looking at ideas for this week, there's a couple that I want to take a look at here. First one I want to take a look at is Chipotle. So if we look at Chipotle here, largely what you have is a breakdown here below 60. We broke that down below 60, traded all the way down to 50, and bounced twice up to this $56 level area before it traded lower. So this is really where after breaking down below a major support level, we managed to rally back up to another resistance level, but so far is at risk of falling behind on this move here on Chipotle. The other one I want to take a look at here is Okta. Okta recently released earnings, and kind of the stock was down nearly 20%, but I really think that this move was overdone here, and I think that you have some bounce potential here for Okta on the stock right now. So those are the ideas that I want to share with you here for today's session. I hope that this was helpful in giving you a better understanding of kind of where we currently stand on a shortened holiday week. So I hope that everyone has a great trading week, and I'll see you guys here next week. Thank you so much and have a great trading day.